Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 at other sectors, other indexes, and even other markets. Now, at the same time, we look inside of the S&P 500 where I have a section where I go through valuation, both looking on a historical basis and looking forward. This video is meant to go with the other videos that I also post each day and each week to give you a big picture altogether of what is happening in the market. This is being prepared from Monday, March 18th. The first area that we look at is valuation. Is the market considered to be expensive, cheap, or fairly priced? Well, the first thing that we look at is we look at TTM, or the trailing 12 months. This looks back at previous earnings, and then there's a PE ratio based on at 10, 15, and 20. When we're at 20 or above, we're considered to be expensive. The black line is the S&P 500. The red dashed line, that's the PE ratio of 20. And we're well above that. And I even break that out down below. When we're above 0, that means that we are expensive on a historical basis. Here is another look just showing you different events that have happened and what the valuations were at that time. And you can see here that the market can spend years being overvalued. And to a degree, some people see that as risk. Other people say, okay, this is nice to know about, but I don't yet necessarily use this to make decisions. And that's kind of where I come out with this. It's just something nice to know. But since we can be overvalued for a long period of time, if we decide to get out of the market for that reason, we'll miss a lot of opportunities. Then there's another thing called the Shiller PE ratio. This was developed by Robert Shiller, and this takes more of a smooth approach over a longer period of time. And he has something called his Shiller PE ratio. You may also know this as CAPE, C-A-P-E. Well, the current reading that we're getting right now is 34.22. Well, to give us some context, we can look at a historical chart going back into the 1800s and seeing that, okay, we're kind of at a high level now, even like before the 1929 crash, even before the 1987 crash, we're at a high level when we look at this chart. We can also look at the mean and the median to give us some kind of an idea of where we're at more on an average basis. And we're between about 16 and 17 when we look at the median and mean. Currently, we're coming in at 34. So on a historical basis, this would suggest that we're also overvalued. But it doesn't necessarily mean the market's going to fall apart. We've been overvalued now for quite some time. Then the market likes to look forward. It doesn't look at what's already happened. It tries to anticipate what's going to happen into the future. And these are forward PE ratios. The red line is the S&P 500. And as of Friday's close, we're coming in at 20.8. So we're above that 20 level, but we have been coming down as stocks have been under a little bit of pressure in Thursday and Friday session. Just to give you a comparison, we also have the mid caps and small caps looking forward as well. They're more low when we look at their forward PE ratio, where the mid caps are right at about 16.3. The small caps are at 15.2, so they're more in the fairly priced area. Then this is another valuation range, and it takes stocks in the US, that's over here on the left, and then looks at all of the world together, and then breaks it down into different areas. Well, when you compare it to the rest of the world, US stocks at the time this chart was created was coming in with a PE ratio of 21.3. So we're above that 20 level. We're also above this normal range here that we typically are in. When we look at the world together, it's under 20, but it's still outside of this range at 18.6. Then we have different areas of the market where they are more in line with what their normal range would be. Then here's another one. It says that the bulls stay long until the S&P trailing, that's the trailing 12 months or TTM, goes over 25. Well, we're not over 25 right now. We are above 20. And if we do get above that 25 level, sometimes there's other times in history when this has produced some kind of a problem. So we just want to keep an eye on that. And this is looking at growth versus value. And it's actually an inverse, because when this is going down, that means that growth is underperforming. Well, since we finally hit some kind of a bottom back in October of 2022, we're now seeing that this is showing a little bit of an improvement where value was coming up, but now it's starting to go back down again. And so this is just suggesting that growth is showing some improvement when we look at all of this together. Then we look at the forward PE ratio. This is looking out 10 years. This is another way to measure this. And we're also coming in above the 20 level, just to give you an idea where we're looking at. This is from FactSet. And then this is when real rates get up over 2.5%. This is when bubbles start to pop. And these are real rates. So this takes inflation into account. So that actually gives us a slightly different numbers. We did have a top and then we started to come back down. We're wondering, is that going to cause some kind of a long-term problem? We don't necessarily see it yet, but we always want to be watching for things. Then this looks at the decline of the euro against the US dollar, and it says here it appears to be structural. The dollar's been bouncing back up a little bit lately, and the euro, that's what's measured first. When this is going up, that means the euro is outperforming, and then when it's going down, that means the dollar is outperforming, and we're right below this trend line right now, and I have a chart later on to show you of the dollar and of the euro. And this is looking at operating margins going out into the next 12 months, the next year. And the takeaway from this, and I put this red line or this red arrow here, where we've been going up, looking here at the S&P 500 index at the time this was created, but we're seeing this blue line starting to come down. That means that operating margins are starting to decrease, and that could put some pressure on stocks. And then here's another look at the multiples where we just take the 10 biggest stocks, and they're currently coming in with a PE ratio of 25, so we're above that level. But when you exclude the 10 biggest stocks, we're right at about 19. So that's more fairly priced or not necessarily considered expensive. And another area that we look at is growth versus value. In good, solid environments, we want to see growth outperforming value. When the market is more defensive, that's when we see value outperforming growth. Here's a chart just of growth. It's the Citigroup Peer Growth Index, and it's showing that we are in an uptrend. And then we look at just a peer value index. This is also in an uptrend. Where we get some insight is when we compare the two with each other. We do a growth to value ratio. And on top, this is showing that growth is outperforming value. And then I do an inverse of that same thing, showing how value is underperforming growth. The reason for the double charts and showing lots of different charts, we want to make sure that we're seeing the same things at the same time. You can see there was a bit of an offset here when we saw a moving average crossover. Then this is looking at a growth to value ETF ratio, showing that growth is outperforming, even though lately it's been pulling back. This is showing how value is underperforming, even though it's been seeing a bit of a bounce. And here's another look at the peer growth indexes, showing how growth is outperforming value, even though they're both in uptrends independently. Then this is a little shorter term look at value to growth, showing how value has been underperforming. And then this is another look showing how growth is outperforming value. And here's another way of looking at it using rainbow charts here. This is showing that growth has been outperforming value, even though it's been pulling back lately. Value has been underperforming growth, even though it's been bouncing lately. Then we break it down a little further and we look at small cap growth to value. And I've been covering this in the daily charts. And this is one of the areas that I've been really focused on lately. And I've included this in the what to watch video that I also put out each week, where we saw a breakout when we compare small cap growth to small cap value, but then we've been chopping more or less sideways. This is still positive for right now. If this really starts to break down, that would turn more negative, but it hasn't really helped the index. We've been pretty much chopping sideways as the small caps have been really lagging behind. And in a more solid environment, the small caps would be doing better than they are. They're the last major index that I follow, anyway, to actually set a new all-time high. The mid caps, which did set a recent all-time high, they're looking a little bit better, even though we saw a decline this past week with the growth to value ratio. Then we look at S&P growth to value, and this is the one that I probably focus on the most, where we are breaking out and going up, even though we've been seeing some recent weakness. We've seen a recent golden cross here showing that this ratio is going up, meaning that growth is outperforming value. We keep an eye on inflation. This is a monthly chart of the CRB. Those are commodities, and we saw a little bit of an uptick so far. We're coming slightly above the moving average, but the moving average is pretty much flat. We also look at a ratio between inflation and deflation on a monthly chart. When this is going down, that means inflation is underperforming or deflation is outperforming. And we have been declining, but now we're starting to get a little bit flat. We had some economic reports this past week, CPI and PPI, that came in stronger than expected. When the market thought, okay, inflation's just going to keep going down, 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 well, those reports put that into some doubt. And so now we're seeing inflation possibly starting to pick back up. And then we look at the CRB index with a daily chart where it's going up. It's still in a downtrend. It hasn't quite crossed over to give us the golden cross yet, but it has been picking back up lately. And then we look at the Baltic Dry Index, which has also been going up lately. This is what does it cost to ship products, specifically in the Baltics, from point A to point B. When this is going up, it probably means they are more expensive. So this can be an inflation gauge as well. Now, there are some folks that take different measurements and shift it forward or shift it back to try to line things up. I just look at this chart for what it is and take it for what it's reading right now. Some other markets that we don't necessarily find ourselves involved in, but we just want to keep an eye on. Here's aluminum, which continues to be in a downtrend, even though it's been bouncing. Corn is in a more decided downtrend. Wheat has also been in a downtrend. So these things going down is typically seen as non-inflationary, or you could take the other side and say it's actually deflationary. Here's a look at fertilizer, and I usually show a longer term chart, but I wanted to break it down a little bit just to give you an idea, showing that after bottoming in December, we are starting to go back up with the price of fertilizer. If this keeps going up, that could be more inflationary. Oil is right at about the 80 level. It's been bouncing around between 70 and 80 lately. If it really breaks out to the upside, that could be more inflationary. If it comes back down into the range that it's been in, that might ease off the pressure a little bit when it comes to oil inflation or deflation. Gas has been going back up, and we're just about getting ready to see a golden cross here, which this is something that we are all impacted with here. With gas prices going up, that can be more inflationary for us. We look at diesel, which has been declining. It was starting to go back up, but in the latest reading, it's actually turning down. And this is what does it cost for trains and big trucks that ship products all over. When the price of diesel goes up, it costs them more money, and that can also be inflationary. Heating oil has still been coming down as we start to come into the spring months. Natural gas has also really been declining lately in a downtrend. Copper, when we saw CPI and PPI come in stronger than expected, we saw copper really bounce up. That means there's economic strength. And usually when the economy is looking stronger going forward, that's when copper has a tendency to do better. And so that's why we saw a bit of a bounce this past week. We look at a copper to gold ratio, and gold's been breaking out and copper's been doing a little bit better, but we are coming back up slightly here with the copper to gold ratio. This just means the copper's been coming up as it's been outperforming gold just recently in the last week or so. Here's a longer term chart of that same thing. When this is going down, that means copper is underperforming. When this is going up, that means copper is outperforming. And then we plot that with a 10-year yield and a 2-year yield, and we see that there's really a wide spread between them right now, where if you look back about 10 years or so, they had a tendency to go in the same general direction and not necessarily get too far apart from each other, even though they are on different scales. Gold is breaking out here, but then it's starting to pull back. This is what the people that really like gold, they were just living for this. And then, unfortunately, about the time the average person gets the news about this is when we start to see it begin to pull back. Now, is it going to turn and go back up? That's what the gold people say will happen. But we've seen breakouts before only to see them actually pull back when it comes to gold. Silver is still in a longer term downtrend, even though it's been enjoying a bit of an upward move along with gold lately. And we look at the closing price on gold on top, where it has been declining over the past few days. Silver is looking a little bit better, and they typically have a really strong relationship with each other, a correlated relationship. When we get a high reading like this, that means they're going in the same direction at the same time. Well, as gold has been pulling back and silver's been going up, we're seeing this relationship weaken slightly. Then we look at the gold to silver ratio on top. When this is going up, that means gold is outperforming. When this is going down, as it has been over the last few days, that means silver is outperforming. Now, sometimes we can plot we can always plot the US dollar index here. Sometimes we can get some insight from that to see if there's a correlation between the two. But right now, we're just around the zero line. That means it's neutral, so we're not seeing any real strong correlated relationship. The dollar could be getting ready to give us a golden cross, even though we've been seeing some recent weakness here, and price right now is below both of the moving averages. We look at the euro, which has been chopping more or less sideways, and we look at the US dollar index, which has been under pressure lately, but bouncing recently. And then we look at the Japanese yen, which has really been underperforming the dollar. And then I have breakout charts here to show you. This is the euro, where it's still in a weakening uptrend when you compare it to the US dollar. And then we look at the Japanese yen, which is in a pretty solid downtrend compared to the US dollar. It was seeing a bit of a bounce, but now starting to go back down. The British pound is still in an uptrend compared to the US dollar, and it was spiking out a little bit, and now it's starting to come back down. We keep an eye on some other indexes, and I do show this every day in the daily video, where the equal weight index, that treats all the stocks in the S&P 500 the same. It's actually holding up when we compare it to the S&P 500, which is a weighted index. So the really big companies have more of an impact on what happens to the index. We also look at the equal weight, and then we do another ratio with the S&P 500. When this is going down, that means that the big stocks, the S&P 500, is outperforming. We're seeing a little bit of a bounce here, and lately we're seeing a little bit of a recovery yet that's going on with the equal weight index, but not enough to really change the trend that we've been seeing. Then we do a ratio between stocks and commodities by looking at the S&P 500 and the CRB index, showing that stocks continue to outperform commodities. This also is an inverse, showing how commodities have been underperforming, even though they blipped back up recently. The NASDAQ 100 to the S&P 500, both are just coming off of setting all-time highs. The S&P set a new all-time high on Tuesday this past week, and the NASDAQ 100 has been doing really well. But we're seeing some profit taking in the Magnificent Seven stocks. Tesla's under pressure. Apple's under some pressure. Google has been under pressure. It seems like it's bouncing off of its 200-day moving average now. But we're seeing this ratio coming down. But longer term, the NASDAQ 100 continues to outperform the S&P 500. The S&P 100 is just showing a death cross here, where we've been seeing the 100 stocks starting to underperform the rest of the S&P 500, and we're actually seeing something new this time. The NASDAQ and the S&P 500 both have been doing quite well. The NASDAQ is coming off recent all-time highs, as is the S&P 500. But as we're seeing a little bit of weakness in tech, this has been coming down, even though the NASDAQ is still outperforming in the longer term. The NASDAQ 100 and the NASDAQ both have been doing really well, but lately the NASDAQ 100 has been underperforming, even though in the longer term it's outperforming. And we look at the mega caps, the really big companies, and compare it with the equal weight index. The equal weight has been holding up a little bit better. So we're seeing, even though in the longer term the mega caps are outperforming, this has been pulling back recently. Then small caps, which has been a real area of disappointment for a lot of folks. The red line is the small caps to S&P 500 ratio. When this is going down, that means the small caps are underperforming the S&P. The blue line here is the S&P itself, just to give us a little bit of context. And here's another look at the small caps to S&P 500 ratio, where it continues to go down, and it's been in a longer-term downtrend. This spike up that we saw, this was last December, when it looked like we might be having the January effect. But ever since then, even when small caps have good days, they tend to quickly give back those gains. The 30 biggest software companies are in an uptrend, but they're still kind of far away from setting an all-time high. Mega caps just continue to really drive the market and are in a solid uptrend. The robotics and AI ETF, this is all the rage now. We're actually seeing a bit of a pullback in this particular ETF, and it's starting to underperform when we compare it to the tech sector. It had been doing a lot better, and now we're seeing some weakness here. This is the Dow Jones Composite Average, which is the Dow, the transports, and the utilities all taken together. The transports are chopping sideways. The utilities are in a downtrend. So we see an uptrend here, and most of that is really coming from the Dow itself. Then we look at the S&P 500 and look at shorter-term bonds. This is showing, even though it's pulling back recently, that the S&P or stocks continue to outperform short-term bonds. We look at the S&P 1500. That's a broad market measure. We compare it with shorter-term bonds, also showing that stocks are outperforming bonds. This is the broad market, another measure across the market, and we look at further out bonds, showing that even though we're pulling back, this is a really solid uptrend, showing that even in the broad market sense, stocks are outperforming bonds. This is a total US stock ETF. And this has 2,651 stocks. And this is coming off of setting recent all-time highs, and it's in a solid uptrend. So this, even though some of the Magnificent Seven are included in this, there's so many stocks in there. If it was only a small percentage of stocks that were really producing all the gains, we wouldn't see this going up the way it is. This is kind of similar, a little bit similar to the equal weight index. Low volatility stocks. This is a little bit of surprise and a little bit of a warning sign. Folks tend to get into low volatility stocks when they're concerned about the market. We've seen a recent golden cross, and this is in a pretty solid uptrend. But at the same time, when you compare it to the S&P, it's really underperforming. Even though by itself it's in an uptrend, when we compare it to the S&P 500, it is in a downtrend. When we look at the tech sector and compare it with 3 to 7 year bonds, still holding up quite well, showing that tech continues to outperform. Then we look at the advanced decline line studies, and I show this pretty much in every daily video. We just look at NYSE common stock on top, and that actually went up on Friday. We saw a bit of a decline with the S&P. We're pretty much flat with the mid caps, and we bounced up a little bit off of the moving average when we look at the small caps. We look at Dow theory, showing that the Dow itself is just coming off of all-time highs. The transports have been chopping sideways and now are seeing a bit of a decline. And if you measured this with moving averages, you would see that the utilities are also in a downtrend. Here's the transportation index itself, which just is going sideways. I keep hearing, watching different videos and reading things saying that, well, this area of the transports is looking strong and this area is looking better. But it's not coming through to the Dow transports index that we follow here. We want to see this turn and go up. If this really was to catch fire and really start to go higher, that would be more positive for the market. We look at a ratio between the transports and S&P, showing how the transports are just really, really underperforming. This is a Dow to transports ratio. When this is going up, that means the Dow is outperforming the transports. And we look at the correlation, not as strong as it usually is. We have the S&P on top and the transports in the middle. When this is giving us a high reading, that means that the S&P and transports are going in the same direction at the same time, and it's actually starting to drop off as the S&P has been outperforming the transports. And here's a new look at Dow theory, where instead of using the Dow, we look at the S&P 500, which is coming off of setting recent all-time highs. And then instead of using the transports, since we live in a tech-based society now, we look at the NASDAQ, and this is coming off of setting recent all-time highs as well. Now, to break that down a little bit different, let's look at the equal weight S&P 500, which also is coming off of setting recent all-time highs. And then we just look at the QQQ's equal weight. So all 100 stocks are treated the same. This is under some pressure right now, but it is coming off of setting recent all-time highs. Here's the Wilshire, another broad market measure. And this is a new chart. I was showing this before, but then they changed the symbol. And I wanted to let this run for a little while before I started to show this chart. These are all stocks together, another way of showing that the broad market is in a solid uptrend. FANG index, Facebook, Apple, Amazon, Netflix, Google, and some other ones. They have been under pressure. They've been going sideways lately, but they still continue to be in a longer-term uptrend. If we start to see some weakness and really start to decline with the FANG index, we'll be looking for other areas of support down here at previous lows, possibly previous highs. I have some lines on here, but as long as we are just pretty much chopping sideways, I haven't really been using this chart. ARK, which was down slightly on Friday, it's in an uptrend, but it really hasn't been participating in the big bounce that we've been seeing in the rest of the market. Then we look at the S&P 500 and we do a ratio with stocks in Europe, Australia, Asia, and the Far East. The line that you see here is that ratio. And when it's above the red line, that means that the S&P is outperforming the rest of the world. And the red line itself is going up. And we can look at the momentum of this ratio down on the bottom by looking at the PPO. And we're flattening out a little bit here, but we're still above zero and for the most part have been advancing. We look at bonds. These are total bonds. These are based on price. So when price goes up, interest rates go down. When interest rates go up, price goes down. And we're seeing that bonds based on price still continue to be in an uptrend. The world bond ETF, so we spread this out a little bit. It's been really choppy, but it's still in an uptrend. It's been dealing with this, what had been support going back to previous lows. They've just been bouncing around all over as the market figures out what's going on as far as inflation. We look at a stock to bond ratio on a monthly chart showing how stocks continue to outperform. Then we break it down to a daily chart showing how bonds are underperforming stocks. These are high yield corporate bonds. You also may know them as junk bonds. These are continuing to do quite well and just coming off of recent all-time highs. Not back to all-time highs yet with this next bond chart. These are more conservative investment grade bonds. They still continue to be in an uptrend even though they have been seeing some recent weakness. We look at riskier bonds, which are junk bonds, and we compare them with more conservative bonds. When this is going down, folks are having a tendency to get more into more conservative, safer government type bonds. Well, with the CPI and PPI that came out this past week, we're seeing this really going back up, meaning that folks are still preferring riskier bonds because interest rates may be going back up. And junk bonds give you a higher yield. And so folks are willing to take on that risk in order to get that yield. And we look at a correlation between stocks and bonds, and it's pretty much neutral right now. When we're going up, that means they're going in the same direction. When this is going down, we're going in opposite directions. This neutral area just shows that they don't really know what they're doing right now. This is the Dow Jones Corporate Bond Index, where it has been pulling back, but it's still in a longer-term uptrend. Here's the 10-year yield with Fibonacci charts. We did get all the way up to 5% with the 10-year yield. We're climbing back up now, and we're wondering, are we going to go back up and retest this 5% level? Or at some point, are interest rates going to start to come down? This is a longer-term look where for a long time, for 40 years, we were seeing a series of lower highs and lower lows as interest rates are going down, 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 down. Now we possibly are seeing a shift into a new environment as interest rates start to go back up. And this is a chart that I've been showing for a while. The reason why I show this is if you look over on the left, when we saw this goes back to last October when we topped out at 5% with 10-year yield. The other times that this happened, this is when we had the Euro crisis, and that's something bad. Another time when this happened, that was before the COVID crash and when everything was shut down, that was bad. Well, when we hit this level last October, this was good. The market was thinking we're going to see a soft landing. The Fed's going to start lowering interest rates. Ah, ha, ha. Everybody's happy. Unfortunately, we have two bad things that happened and one good thing that happened, and we're getting the same kind of readings here. We're still waiting for this to be played out, but it's really rare for this to hit this kind of a level and then bounce up off of that on good news. Usually it's something bad that happens, and maybe something will eventually develop. We can only go with what we see right now. This is the 30-year yield, just showing in relation to its different Fibonacci retracement levels. This is comparing stocks with the 10-year yield, showing that even though stocks have come down over the last few days, they still are outperforming the rise in interest rates. And this is 3 to 7 year bonds and comparing it with stocks. This is the inverse of stocks to bonds. This is bonds to stocks, showing how bonds are underperforming. Junk bonds consider to be holding up quite well here and are in a pretty solid uptrend and starting to go back up when you compare junk bonds, riskier bonds, with more conservative bonds as the market's getting a little more fearful about interest rates. This is the price of the 7 to 10-year bond ETF, which really got hit hard. It's dropping below its 50-day moving average. The RSI is dropping below 50, and the momentum is starting to drop negative, but we're still in a longer-term uptrend when measured by the moving averages. Here's a daily look at the yields where we hit a top back in October, and then we started to come down. We've been drifting up. Then as stocks were going up, interest rates are going down, but now interest rates are starting to go back up. There's a weekly chart with the US, UK, and German rates all advancing this past week. Japanese rates are a lot lower, but they're also increasing. Then we have the MOVE index on top, which measures the volatility of bonds, and the VIX, which measures the volatility of stocks. Down on the bottom, we look at the correlation, and they're pretty much neutral right now. They're not going in the same or different directions. Here's a monthly chart of the price of the 30-year bond ETF, and it has been under pressure as interest rates have been going back up. We're below the red line and declining. On the bottom, we have a bond to CRB or commodities ratio showing that even in the longer term, the price of bonds continues to outperform commodities. Then we look at different sectors. We compare the materials sector and all the other 11 sectors of the S&P 500 with the S&P itself, where this is showing an improvement, but longer term, it still continues to underperform. Communication, this has been one of the stronger areas, but lately has been pulling back. Energy has been in a downtrend, but it saw a real surge this past week. The financials continue to hold up fairly well, even though we're kind of watching to see if there's going to be more bad banking news that hits the market. And the industrials are also showing some improvement and coming back above their moving average. Not enough yet to generate a golden cross, but still showing some improvement here. The tech sector has been the strongest area. Even though it's been pulling back lately, it's still in a longer-term uptrend compared to the S&P. Staples continue to be in a downtrend compared to the S&P. Real estate, we saw a bounce here as interest rates were starting to fall. Then as interest rates are going back up, it was down. And real estate has just really had a difficult time, especially when compared to the S&P 500. Utilities are also underperforming the S&P. Here's a ratio that we look at. When this is going up, that means the S&P is outperforming utilities. When this is going down, that means that the S&P is underperforming utilities. And it's been declining a little bit lately as stocks have been under pressure. Healthcare continues to underperform the S&P. This also shows how healthcare is in a downtrend. And this is one of those areas you need healthcare no matter what's happening economically. So this is more of a defensive area. And the fact that we're in a more of a growth mode is why this is underperforming. And we look at discretionary. This is the thing that makes life fun. Where it had been doing good, it was seeing a real nice upward move. It was one of the stronger sectors for a large part of 2023. But Tesla's in here, and Tesla's under pressure, and that's really making this ratio go down. The staple sector, another area. These are things that you have to have no matter what's going on economically. This continues to be in a really solid uptrend, and this is more defensive in nature. And we look at the tech sector, which has also been performing well, even though it's been seeing a recent pullback. The semiconductors just going to the moon. Well, they're coming back for a little vacation, at least for a while here. The tech sector to the S&P 500 shows that the tech sector is still longer term in an uptrend, but it has been seeing some weakness. Energy, which is in a downtrend compared to tech lately, has been outperforming as we've been seeing a little bounce in the energy sector. The growth sector compared with bonds shows that stocks are outperforming bonds when looking at this chart. This is the tech sector to the rise in interest rates, where the tech sector has been outperforming, even though lately it's been pulling back. There's an inverse showing how the tech sector, the 10-year yield has been underperforming the rise in the tech sector, even though it's been bouncing. This is discretionary, the things that make life fun, compared to staples, the things that you have to have. It's still in a longer-term uptrend, but we have been seeing discretionary showing some weakness lately. In a more solid environment, we want to see this discretionary outperforming staples. This is showing how staples is underperforming discretionary, but seeing a recent bounce. Here's gold to the S&P, which is still in a longer-term downtrend on a ratio basis, even though gold has been doing well. And gold has been breaking out a little bit. We've lately seen some dollar weakness before we saw a little bit of a bounce. And gold has been breaking out, and we're coming back up to this trend line on the daily chart. High leverage loans continue to do quite well. These are risky loans, and they're just coming off of setting all-time highs. The NYSE composite, this is a broad market measure, also in an uptrend. All stocks in the US and internationally is also in an uptrend. Emerging markets, seeing a little bit of bounce here and still in an uptrend, but pretty much chopping sideways. The Japanese Nikkei, that's their big index. It finally surpassed the high set back in 1989. Now it's starting to come back down. The small or micro caps, these are the really small companies. They're still in an uptrend as well. And then we keep an eye on the home builders ETF. Just to make this a little shorter, we're not really seeing anything right now. We look for divergences here, and we're just not seeing them at the present time. Bitcoin, just coming off of setting all-time highs, has been since pulling back. And then we look at internationally, and we look at stocks in China, which continue to be in an uptrend. Emerging markets are in an uptrend. We're rolling over a bit in Europe. Japanese stocks are in an uptrend, and we're pretty much flat according to the KST with stocks in the US, even though stocks have been performing quite well lately. Intermarket analysis showing that oil is in the lead, followed by stocks, then gold, and then the dollar. The price of bonds are negative on the year currently. Then some correlations. We look at the S&P 500 to the US dollar index. They're having a fairly strong tendency to go in opposite directions. So if stocks are going up, chances are right now the dollar's going down. If the dollar's seeing some strength, that may put some pressure on stocks. We look at the correlation between the S&P and oil. This has dropped back into neutral territory right now. And the S&P and the 10-year yield also dropping back into neutral territory. And then the 10-year yield to tech is right about as neutral as you can get. And then the 2-year yield, shorter term yields here, also coming back down and being neutral. Then we look at some long-term charts. This is a monthly chart of the NYSE, which continues to go up and is above the red moving average. That's long-term positive. And when we look at the momentum, it continues to be positive. Here's a daily chart of the NYSE, and we're seeing a thing called the NYSE Record High Percent Index. This is continuing to go up as well, and that's more positive for the broad market. Here is a monthly chart of the S&P 500, which is really doing well on a long-term basis. The momentum continues to do quite well. We do a ratio between the S&P 500 and commodities, showing how stocks are still outperforming commodities. And this can take some time to really change over a period of time. This is a monthly chart here. And then we look at the S&P 500 and then another global index and on a monthly chart showing how the S&P is outperforming. We're kind of right on top of the moving average with the KST. If we see more strength in U.S. stocks, we would probably see this turn more positive. Then at the very end, I take all those things that are positive, and my definition of positive is when the 50-period simple moving average is above the 200-day simple moving average. So we have the growth indexes by themselves as well as the value indexes by themselves. And copper is still in an uptrend, the British pound and the euro compared to the dollar, gold, the big software companies, mega caps, the FANG index, ARK, low volatility when you take it by itself, the staples, the Dow Jones Composite Average, all the different bonds that we look at based on price, the tech sector as well as semiconductors, high leverage loans, the Dow, the NYSE Composite, as well as the Wilshire. Those are two broad market measures that we use. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. Even though small caps have been very frustrating, they are still in a longer term uptrend. All stocks, emerging markets, and then if you can see at the bottom, it should be Bitcoin. And then the last slide is when we look at those things that are negative. This is when the 50-period simple moving average is below the 200-period simple moving average. We have the dollar, and we might see a change in that if we see more of a bounce out of the dollar index. The CRB index also up recently, but still in a downtrend. Silver still in a downtrend, and the Japanese yen compared to the US dollar. Thank you. I hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.